Now let's take a look at the bigger picture. Ed Siddell's with us, CEO and Chief Investment Advisor at EGSI Financial. Good to see you, Ed Siddell. What are you thinking here? We got in lots of news, including the retail report. Did that jump out at you?
You know, it did. Well, thanks for having me back, Nicole. I think, honestly, it's a lot of smoke and mirrors because, even though retail sales are up, it's not adjusted for inflation. And I think it's just really is a sign of things to come, just like with the Home Depot's report. They revised their original report as far as sales being flat across the year to, they're estimating their sales being down 3 to 5% this year. So that's, again, I think this is a sign of things to come, and consumers are really starting to feel the slowdown.
Right, and that's the whole bit. I mean, when we get through what's going on in retail sales, of course, it was an improvement month over month and shows some resiliency on the part of the consumer. Right. But the question is, how much of a pinch they're really feeling pertaining to inflation, as you noted. That being said, the bigger picture here, as we look at the markets, what are you seeing there? You even noted some bankruptcies.
Yeah, the report came out, Bloomberg actually reported on it. It said that, the 7 companies inside of a 48-hour period filed for protection, Chapter 11. And each one had at least $50 million in liability. So, we haven't seen this kind of debt and bankruptcy since 2008. As we continue to see this, this is going to have an effect on banks. And I think banks are fragile right now. I'm not saying that we're going to continue to see more bank failures, but this could present a huge problem, not just for banks, but for the markets and the economy as well.
Right, understood. So how worried are you about some of the regional banks and whether or not there could be some sort of story there? The theme that I'm hearing from folks are there's still too many banks.
Well, yeah, and again, we don't know the exposure, the risk that they took. If they hedged, if they removed their hedge like SVB did, so we don't really know what the outcome is going to be. But again, I think all banks are fragile right now, except for probably maybe even the big 3 or 4. So it's kind of like buyer beware. When you're looking at your investment accounts, your retirement, your 401k, now is the time to be cautious and really hedge and understand the situation that you're in, so that you can make sure that you preserve and protect your savings. And I think that's the situation that we're in right now.
So you said, a debt bubble. Are you concerned at this point? And so what do you mean by that? Why does it matter?
Yeah, and we've been talking about this for a year. When you give away free money, the amount of debt that we have at basically 0% interest, it's all starting to come due now. And as it starts to come due and you go from paying, 1-2% to now all of a sudden you're paying 5, 6, 7, 8%. This is why we're already starting to see the bankruptcies. I mean, we had a significant amount of bankruptcies in January this year already. We're starting to see layoffs. Meta just announced another set of layoffs. And so as they service this debt, when you raise interest rates 525 basis points in a little over a year period, it's going to have a significant impact on these companies and just being able to, take care of cash flow. So I don't think we're out of the woods. I think that, this could be systemic all the way across the board. And like I said, this is why the banks are very fragile right now.
Right, understood. So what would you advise to the clients? What are you telling them? I mean, you have bankruptcies, you have debt, you're concerned, but at the same time, right, we got to invest. What do you tell them?
Yeah, well, for us, it really is a hedge. I like precious metals, short-term instruments, short-term treasuries, money market funds. We need to make sure you can't be completely in the market. You can't be completely out. But, you need to make sure that you're protecting yourself and have enough liquidity on hand so that, if and when things do turn around, you can take advantage of it. I still think that there are some really good buys out there, some companies that have very strong balance sheets. We just talked about Amazon, you did on your show. I do like Amazon. I like Apple, Berkshire Hathaway, those companies that are very strong and can weather the storm, and those are longer term plays. And that's really how you have to look at it. If you're looking at buys right now, you've got to look at it for the long term, not just for the next 12, 24, 36 months. These are long term plays. And I think they're going to, weather well.
Yeah, so metals and short-term plays like the short-term, government investing in that.
Yep.
You have bonds and things like that, and
1-year
money
treasuries or
markets.
less.
1-year treasuries or less. At this point now, are there sectors that you like, or are you pretty much staying away from equities for the most part?
Yeah, other than the ones that we just talked about, again, there are certain stocks that we like, but as far as sectors, everything is kind of up in the air right now. There's so many things that we really need to see how they play out. We need to see what happens June 1st with the debt ceiling. As banks continue to file their earnings. I think that once we understand how things play out, then we can kind of look at, say, all right, I think it makes sense to get back into the market, and these are the sectors that we like. Because even in the beginning of the year, I really liked gas and oil. And I thought the demand was going to be up, but we're seeing a global slowdown. I mean, even gasoline sales were down last month. So again, I think we're starting to see the effects, not just here in the U.S. but globally. And it's kind of a wait and see.
Right, and how worried are you about a recession?
Oh, I think we're, in a rolling recession and have been. I think we're going to see the full effects probably by the end of the year. And it's just a matter of, how big of a recession and for how long. But, I think it's looming. I really do.
So you think it's gloomy? What could change it? I mean, the Fed right now has the choice of raising rates or not in June. What do you think about that?
You know what? They've kind of backed themselves into a corner, and that's the issue that we're facing right now. They caused the problem, right? Free money for such a long period of time, and then all of a sudden they said, you know what? We've got to stop printing money. Well, with the no bailout, we stopped the quantitative easing, but anything that we took off the balance sheet from the feds, we put back on when we bailed out SVB and some of the other banks. The government is still spending, so that's inflationary. If the feds really want to get to that 2%, I don't see how they're not going to be able to pause. They're going to have to keep raising rates, but if they do, it's really going to hit hard on the economy. And again, that recession at that point in time, I think, is going to be really deep, and it could be long. I think it'll stretch from the end of this year all the way through 2024.
Right. Oh, understood. Ed Siddell, thank you so much. It's great to see you. EGSI Financial. Thank you, Ed.
From the board for re-election, he won't be a campaign surrogate, if you will. But look at what Mayor Adams is dealing with. Every migrant that crosses